Well, Indian stocks, which are already struggling with low profitability and selling by foreign investors, are under additional strain. And that is due to a barrage of share sales through IPOs and sales to institutional investors. In Thursday's largest IPO in the country, Hyundai Motor India raised $3.3 billion in addition to the listings totaling $6 billion, which are in the pipeline. The bullish sentiment in the Indian market has invited more supply. The IPO barrage comes when global fund withdrawals are totaling more than $7 billion this month. And all this amid declining corporate profits. The stock market is on track for its worst month in over 2 years. This even as strong buying by regional institutions has mitigated the foreign investor withdrawals. Well, Ashish Gupta, Chief Investment Officer at Axis Mutual Fund, which has $37 billion in asset under management, said, given the increase in supply, strong domestic fund flows might not be sufficient to ensure that the market is only in an uptrend. With Hyundai's proceeds, India's IPOs will have raised more than $12 billion in 2024, surpassing volumes for the past 2 years. Adding to this influx are sharp sales of $25 billion by the company founders, the most in at least 5 years. Still, history suggests caution with large share sales. Of the 5 IPOs worth at least $2 billion since 2007, only 2, DLF and Coal India, delivered positive returns within a month of listing. The offerings also tend to coincide with market peaks, with broader indexes typically declining in the weeks after these stocks start trading. Separately, the conversations will continue to center on Indian banks' growing credit expenses and their battle to draw in client deposits to offset them. As Indians increasingly place their money in equity funds rather than savings accounts and fixed deposits, banks that have relied on client deposits to sustain their operations have experienced a decline in these deposits in recent years. India's central bank has expressed worries about unsecured loans and the need to reduce loan-deposit ratios. This has pushed the lenders to halt credit growth, particularly in retail areas. Markets are also split on a rate cut in December after inflation accelerated at a faster pace than expected last month. With high rates, banks also face high credit costs because of the lag in the repricing of deposits, which will worsen once rate cuts kick in.